Welcome to Lecture 8 in Applied Portfolio Management on the topic of value investing. This lecture examines value investing as another investment strategy that portfolio managers can adopt in order to maximise the utility of their investors. Now, once again, we take ourselves back to the Mark Coype's portfolio optimisation that we looked at 2 weeks ago, whereby we said the biggest limitation of that particular model was not the maths, which in fact is perfectly tractable, but the use of assumptions in terms of expected returns and covariances. And in particular at the time we identified that there's potentially a weakness in terms of assuming that beta is the only factor that might explain returns. Now last week we saw evidence that momentum is an additional factor that also appears to be able to explain expected returns. This week we're going to look at another possible factor, and that is value. So value investing has taken many forms since its inception, but it's based on the simple principle of buying securities whose current price appears to be low compared with its intrinsic value. So you're trying to identify underpriced stocks. Now there's a number of ways which this can be achieved, and obviously the problem with value investing is that it relies upon some model of intrinsic value. So the investor needs to be able to identify the price, which we can see from market prices, but also compare that price to some measure of value. So while it's not perfectly clear how we actually identify value stocks, it is a popular investment strategy. And this strategy is based on the philosophy that investors tend to overreact to growth prospects. So we tend to over-extrapolate growth prospects beyond their realistic value. We focus heavily on the next big thing, and we assume that growth maybe is going to continue into perpetuity. And what that means is that more boring stocks that maybe have lower projected growth rates become neglected, and their price becomes lower than the expected present value of future cash flows. Because it's important to note, as Ben Graham noted way back in the 1970s, that obvious prospects for physical growth in a business do not necessarily translate into obvious profits for investors. What we need to be looking at is a stock whose current price is actually lower than our expected present value of future cash flows. Now there are several different approaches that can be adopted by value investors in this quest for identifying stocks that currently have a low price relative to their intrinsic value, but the most common one is the use of passive screens. So passive screens is whereby we come up with measures that we believe to be objective measures of firms that are undervalued in terms of their price relative to its intrinsic value, and we use those screens to identify which stocks to buy and which stocks to sell. Now passive screens in terms of value investing have been around a long time. They were popularised by the famous investor Ben Graham back in the 1970s. And Ben Graham possibly most famous for the fact that one of his students and disciples was a gentleman by the name of Warren Buffett. Warren Buffett is the most famous value investor that we've seen to date. But when we look at passive value screens, there are 4 common screens that are used. These screens are the book-to-market ratio, the price-earnings ratio, the price-to-cash flow ratio, and the dividend yield. So let's quickly go through each of those and identify why they might be metrics for value. So first of all, the book-to-market ratio. In the book-to-market ratio, what we're saying is we're assuming that the accounting book value of assets is a measure of the intrinsic value of the firm. And if we take that as our measure of intrinsic value of the firm, then the ratio of that accounting book value to the market capitalisation should give us a ratio of what's implicitly intrinsic value to price. Therefore, stocks with a high book-to-market ratio should be value stocks, because they're stocks that have a low market price relative to the intrinsic value of the firm. So an investor who uses the book-to-market ratio passive screen will buy stocks with a high book-to-market ratio and sell stocks with a low book-to-market ratio. What they'll tend to then do is, at the end of every year, rebalance their portfolio. So they re-examine the book-to-market ratio of stocks at the end of each year, reconstitute their portfolios so that the value portfolio continually comprises stocks with a higher book-to-market ratio, and roll that portfolio over year after year with that annual rebalancing. And evidence shows us that if you do buy stocks with a high book to market ratio and sell those stocks with a low book to market ratio, that investment strategy tends to earn a premium of about 4% per annum. So it's quite a significant abnormal return that can be generated. The second value screen is the price earnings ratio. So the price earnings ratio is the ratio of share price to earnings per share. So in this case, we're using the firm's profit as a measure of its intrinsic value, and the price earnings ratio is the ratio of what multiple or how many times profit do you have to pay in order to buy that share. So a stock with a low price earnings ratio will be one where you pay a low multiple of current profits in order to buy the stock, and that would be considered a value stock. Now similarly, there's evidence that an investment strategy that buys low PE stocks also outperforms over the long term. The third value screen is the price to cash flow ratio. So this is similar to the price earnings ratio, except we're not looking at accounting earnings, but what we're looking at is net cash flows of the firm. Now, this is a slightly different iteration on net profit, and it's based on the view that net profit can be manipulated, particularly in the context of an accrual accounting system. However, it's much harder for businesses to manipulate net cash flows. Therefore, we substitute in net cash flows for net profit, and the price to cash flow ratio is just, again, the ratio of price divided by annual net cash flows. So it's a measure of what multiple of annual cash flow do we have to pay to buy that firm. So once again, a stock with a low price to cash flow ratio will be a value stock. Last screen, and probably the one with the least amount of evidence supporting it, is the dividend yield. This is the idea that stocks with a high dividend yield are a value stock, and stocks with a low dividend yield are growth stocks, because those companies are reinvesting profits back for future growth. There is a small amount of evidence regarding the dividend yields, but it's quite moderate, whereas the other three screens, book to market ratio, price earnings ratio, and price to cash flow ratio, are strongly supported by academic evidence. The second approach to value investing is the contrarian value investor. Contrarian value investors identify value stocks based on their past price performance. Now you might think, well, last week we looked at using past price performance to identify which stocks to buy and sell in our lecture on momentum. But contrarian investing is actually subtly different. In fact, contrarian investing is the idea that stocks that have had very good performance over the long run or over the long time period of history will actually subsequently underperform, whereas those stocks that have had very poor prospects will overperform in the future. This is the idea that if the stock's price or the stock's performance is low, that becomes a value stock. So then you might ask, well, isn't that naturally inconsistent with momentum, which says that you should buy recent winners and sell recent losers? Well, it's not, and the reason is as follows. Momentum focuses on intermediate period returns. That is, with a momentum strategy, we're looking at past returns over the past 3 to 12 months, and then we're looking at holding that investment for a period of the next 3 to 12 months before we reevaluate our portfolios, rebalance, and move forward accordingly. Whereas a contrarian investor will look at long time periods. That is, they'll look at holding their portfolio for, say, a period of 5 years rather than just rebalancing every 1 year, because there's evidence that suggests that over a long time period, such as 5 years, there is actually mean reversal in prices. So momentum investing and contrarian investing can actually be naturally consistent with each other, and in fact the contrarian phenomena that we see in returns is actually part of the explanation for momentum profits that we spoke about last week, which is short-term underreaction and long-run overreaction to prices. So the contrarian value investor will seek to profit from that particular approach, buying stocks that have done poorly and holding them for 5-year period. The third approach to value investing is activist value investing. Activist value investing is a little bit different to the other approaches because it's not necessarily identifying a stock that's current price is lower than the firm's current intrinsic value. It's actually about identifying a stock where its current intrinsic value is lower than what that intrinsic value of that company would be if it was operated more efficiently. So it's actually about identifying inefficient companies. In this particular case, what the activist investor will seek to do is actually engage in a takeover, buy out that company, make significant changes in order to close what is called the value gap. The value gap being the difference between current intrinsic value of the firm and what that intrinsic value would be if the firm was operated entirely efficiently. And the way to close that value gap is by redeploying assets, changing maybe the capital structure or the dividend policy of the firm, and improving the management and the corporate governance of the firm. So we use our knowledge and understanding and philosophies from corporate finance to improve the business. And in that sense, we don't need to rely on the fact that prices are inefficient at all. It could be that the price that you buy that company for is exactly its current intrinsic value, but again, you're focusing on putting your efforts in terms of improving the intrinsic value because the company is not currently operating at full capacity for some reason. Maybe poor management, maybe it's too large, and a common strategy by an activist investor will be to focus back on core business and sell off a lot of additional assets. So that's a key summary of value investing. What we just want to move on to very quickly to finish this lecture is the fact we've now looked at the two most prominent smart beta factors being momentum and value. However, if we look at both those factors, the problem is that while they look at both the past price performance of the stock and the intrinsic price of the stock respectively, both of them pay no attention to the firm itself and the fundamentals of the firm itself. So two additional smart beta factors that have been proposed are those that actually focus a little bit more on some of the characteristics of the firm, and they are the low volatility anomaly and quality factors. So these are two additional smart beta factors. So low volatility, first of all, this is the phenomena that stocks with low volatility or low risk actually tend to earn positive abnormal returns, so that's positive risk-adjusted returns, while stocks with high risk or high volatility actually tend to earn negative risk-adjusted returns. So this is the idea that after controlling for risk, you're actually better to invest in low-risk firms rather than high-risk firms. Quality factors or quality investing is about identifying firms that have good quality. So what does good quality mean? It might mean good management, it might mean good profitability, it might mean you've got a firm that's not engaging in hubris, which is unnecessary growth. And we find that there's a lot of different measures of quality, so identifying firms that do not have significant year-on-year growth of assets, that can often be a negative signal of hubris. Identifying firms that are not trying to time the market and continually issue new share capital. Identifying firms with good profitability and with good corporate governance. And there's a whole lot of evidence that shows that investing in high quality firms actually results in positive abnormal return performance. So low volatility and quality, both of them appear to be additional smart beta factors that are quite relevant for investors. So why is this important in the context of value investing? Well, as I mentioned earlier, value investing simply seeks to identify cheap stocks, but these stocks could have poor underlying fundamentals. So Asness et al. Actually proposed that if you're implementing a value strategy, you should actually look at combining value with quality with a strategy that they call quality at a reasonable price, in that you're identifying cheap stocks, but you're also identifying stocks that have good underlying fundamentals. Alternatively, Standard & Poor's have introduced a new index called the S&P GIVI, G-I-V-I, which is actually a rules-based index that combines low volatility with value. The idea here being that you can take advantage of identifying cheap stocks, that is the value stocks, but also exploiting this premium earned by stocks that have low volatility or low risk. So you're screening out those cheap stocks where the returns are highly volatile. And again, combining value with low volatility appears to generate significant positive abnormal returns. So that's a summary of our lecture on value investing, the second of the smart beta factors in terms of our security selection decision. And there's significant evidence that value as well may be a factor in estimating expected returns. Hence, it may be another approach that investors adopt as they're part of their investment philosophy.